How is everybody doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, we're going to be reviewing the FDIC's Quarterly Banking Profile. This is a report that comes out every quarter issued by the FDIC, and we get a chance to take a look at how are community banks doing, how are large banks doing, and it's a great profile report just to kind of give you an industry snapshot and let us know what is going on. So, here is the actual report itself. We're gonna zoom in here in a minute, but I wanted to kind of take a step back just to give you guys kind of a look at what this looks like. And in the description down below, there will be a link to the report if you want to go check it out. And there will also be a link to a previous episode. I thought I had covered the report for the first quarter of this year, but I didn't. But I did cover the fourth quarter of last year. So I'm going to put a link to that episode there if you want to go. And the reason why I probably would go back and take a look at that episode is that I get a little bit more in depth, kind of explaining the report itself. I'm not really going to do that so much here in this episode. I'm really just going to kind of hit the highlights. So, but like I said, if you wanted to go back and get kind of a little bit more in-depth explanation on the report, go back and check out that previous episode, which is not that long. So, but okay. I want to hit the highlights on this just to kind of run down, let everybody know what's going on here. So community bank net income rose 1.1% in the second quarter, but remained down 8.2% from a year ago on higher non-interest expense, according to the FDIC's latest quarterly banking profile. So what were the key drivers? So higher net interest income was up 2.7%, and higher non-interest income was up 5%, which offset higher non-interest expense, which was up 2.1%. And higher provision expense was up 18.2%. So in other words, provision for loan loss reserves. In other words, banks are expecting more losses on the horizon. Therefore, they increase or beef up their loan loss reserves. And 18.2% is a very healthy increase, to say the least. So you have higher net interest income. So basically, that's the revenue for banks. Banks make interest income off the loans that they're in their loan portfolio. And think of like a typical business. Business has revenues that they generate from sales of their product. Well, that the bank's product is the loans that they issue. So they issue the loans, they earn the interest. That is their revenue, making that interest come in. So higher net interest income because rates are up. So their net interest income went up by 2.7%, but they also had higher non-interest income. Non-interest income would be, fees, other sources of revenue for the bank that they have coming in. So that was up 5%. And that helped, like I said, helped to offset the higher non-interest expense, which was up 2.1%. Okay, so for the second quarter, so pre-tax return on assets ratio increased 1 basis point from the previous quarter to 1.14%. The net interest margin increased 7 basis points from the last quarter to 3.30%, reversing a 5-quarter declining trend. So that's good. Net operating revenue increased 3.2% quarter over quarter on higher real estate loan income and higher net gains on loan sales. Non-interest expense increased 2.1% from the previous quarter and 5.6% from a year ago. And quarterly provision expense, like I said, was up 18.2% and 30.6% respectively. So that's a pretty sizable increase there. So unrealized losses on securities declined 1.4% from the previous quarter and 12.3% from the previous year, although that still remains a ginormous problem for the industry. Total assets increased 0.5% quarter over quarter and 3.9% year over year. Loan and lease balances grew 1.7% from the previous quarter and 6.3% from the prior year. The loan growth was broad-based across categories, however, still rather light. Deposits increased 0.2% from the previous quarter and were up 3.5% from a year ago. Deposits increased 1% from the previous quarter and were up 2.9% from a year ago. So kind of interesting that it says deposits and deposits. So the share of non-current loans and leases increased 3 basis points from the previous quarter, while the net charge-off rate increased 2 basis points. So the overall industry, so the overall banking industry reported an 11.4% increase in net income from the previous quarter due to a decline in non-interest expense and one-time gains on equity security transactions. So in other words, banks are selling a lot of stuff to reposition their balance sheets, as I pointed to a second ago about the unrealized losses on securities declined. So overall, the banking industry, the net income was up, from the previous quarter. Banks continue to work through the issues on their balance sheets. And the Deposit Insurance Fund, or known as the DIF balance increased $3.9 billion to $129.2 billion, while the reserve ratio increased 4 basis points during the quarter to 1.21%. And then on the merger and acquisition front during the quarter, the total number of FDIC insured institutions declined by 29 to 4,539. 3 banks were sold to credit unions. 26 institutions merged with other banks. 1 bank failed in the second quarter, but did not file a recall report in the first quarter, and no banks opened. So continuing to see the number of banks declined, albeit a little bit more slowly right now because of issues in the M&A market. If you haven't seen any of my more recent episodes in the last few months on basically the M&A market, M&A transactions, go check that out. But here, just going into the report for a second, and we'll kind of zoom in here to make this a little bit easier for people to see. And again, I don't want to rehash all this stuff. Like I said, I just kind of read through the highlights here, but like when you see this report here, what you get is you kind of get like the headline information. The DIF reserve ratio, domestic deposits, decreased from the last quarter. Loan balances increased modestly. Asset quality metrics remain generally favorable, though charge-offs increased. Provision expense increased from the previous quarter. Net interest margin increased quarter over quarter for all size groups except for the largest banks. Net income increased from the prior quarter, driven by lower non-interest expense and non-recurring gains. So, the industry's net income increased. The net interest margin increased quarter over quarter. And that, like I said, so it gives you kind of the main bullet points here at the top, and then it proceeds to run through each one of these as it goes down with a little bit more information. Net operating revenue. So let's say we wanted to jump down to provision expense, because that was the thing that jumped out at us. So you kind of roll down here and you say, okay, provision for credit losses totaled $23.3 billion in the second quarter of 2024, up $2.7 billion from the previous quarter. Provision expenses have been higher than the pre-pandemic coverage for the past 8 quarters. Provisions increased the most at banks with more than $250 billion in assets. In other words, your large regional banks. Up $3.3 billion, 30.3% from the prior quarter. The increase in provision expense reflected loan growth, deterioration in office markets, and high credit charge-offs. The reserve coverage ratio, the ratio of the allowance for credit losses to non-current loans, increased from 192.8% in the previous quarter to 194.2% because the allowance for credit losses increased at a faster pace than non-current loan balances. So also what is driving part of that is what's called the Basel III Endgame. It's this regulation that's coming out, which is basically going to require larger banks, the larger regional banks, the biggest banks, to basically hold more capital. So again, that's part. While none of that has been finalized, it's all very much fluid and in a lot of discussion. They're obviously making they're trying to get ahead of the curve or hedge their bets, so to speak, however you want to look at that. So asset quality metrics remain generally favorable again, though charge-offs increased. Unrealized losses on securities decreased from the previous quarter. However, you can see here, so unrealized losses on securities totaled $512 billion in the second quarter, a decrease of $3.6 billion from the first quarter. But obviously, $3.6 billion decrease when you're looking at a $512 billion loss is that's not really doing a whole lot. So obviously still a huge issue for the industry. Banking industry assets decreased from the first quarter. So banking industry reported total assets of 23.9 trillion, a decrease of 70.5 billion. The quarterly decrease was mainly due to reductions in cash and balances due from depository institutions and securities. In other words, banks selling their securities to rebalance their loan portfolios. Loan balances increased modestly from the prior quarter because loan demand is not really that great. Domestic deposits decreased from last quarter. So domestic deposits decreased 197 billion from first quarter 2024, well below pre-pandemic average second quarter growth of 0.2%. Both savings and transaction deposits declined from the prior quarter, with growth in small-time deposits partially offsetting the declines. Broker deposits decreased for the second straight quarter, down 10.1 billion from the prior quarter. Banks with more than 250 billion in assets drove the quarterly decline in deposits. Now, again, I believe it was the FDIC. They just put out a kind of a new proposal on broker deposits where they wanted to kind of reclassify what constitutes a broker deposit. It basically has created a lot of uproar because it would change how banks have to kind of manage their liquidity in certain respects, and how and how certain things are categorized, and that also leads to potential capital issues with how you calculate some of the capital ratios and things like that. So a lot of pushback coming on what they're trying to do there in terms of qualifying broker deposits. So definitely more to come on that. Equity capital increased from the first quarter. Number of problem banks increased, but it was just a couple. The deposit insurance fund and then the total number of insured depositors declined. Now, here's what you get when you get down into the lower part of the report. The total report is about 32 pages, but you get a lot of numbers. They break down quarterly banking profile, and you could dig into some of these numbers here a little bit more as you kind of scroll down here. And I am trying to get to something specific here as we go down here. So, okay. So what they do is they break this down by community bank performance, and then you get into kind of large bank performance. So if you wanted to come down here and say, okay, how are community banks doing? You could look at the metrics specifically for, community banks. So you kind of get at the very beginning, it gives you like what's going on in the banking industry overall. And then it breaks down to community banks. And then as we scroll down here a little bit further, we'll go down as we come down to the bottom of the report, if I can get there. Okay, insurance fund indicators. And this is kind of interesting, the DIF, the deposit insurance. You kind of see how that deposit insurance fund is looking at, and then it kind of gets down here to quarterly, notes to users. And, kind of like different methodology, different things that they use to calculate the different numbers and stuff like that. Then it gives you definitions on different terms and a lot of good stuff here. So it's a great report. Really like this report. A lot of really good detailed information on here. Kind of gives you an idea of what's going on in the industry as a whole. And then you can kind of look down into you could kind of break it down more into community banks and what's going on with that. So hopefully that gives you a little bit of detail. Basically, in a nutshell, things are okay. They're not fantastic, but they're okay. Basically, profit margins are doing good. Profits are up a little bit, even though they're down year over year. But the deposit insurance fund is solid. Industry is doing okay overall. But there are some. There are some clouds on the horizon, if you were, in terms of, troubled loans are starting to pile up. Defaulted loans are starting to pile up, that particularly that commercial office space is still, a big issue. So a lot of things to kind of keep an eye on. But hopefully this was a great report. Hopefully, if you're seeing this for the first time, maybe you learned a little something here with this. And but if you're a seasoned pro, if you're in the know, hopefully this just kind of maybe confirmed or gave you a little bit of information of stuff that you might have been looking for. So, but anyway, I'll wrap this up with, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Please remember, we are on YouTube, Rumble, and all major podcast platforms. Please make sure to leave your comments down below. Check out thebankernextdoor.com, and I will see everybody again real soon. Thanks a lot.